Hey everybody, welcome back to Whiteboard Finance. My name is Marco and I'm here to help you master your money and build your wealth. In today's video, I have a free masterclass or a free beginner's course on how to actually get started investing in stocks and the stock market. So even if you're a beginner, intermediate investor, or even an advanced investor, I promise you there's golden nuggets all throughout this video. We'll be talking about what a stock actually is, different sizes of companies, different calculations to make sure you're making the right investment, and we'll also be buying and selling a stock live later in this video. So let's get right into it. So this presentation is called How to Invest in Stocks for Beginners, Step by Step, presented by me, Marco, Whiteboard Finance. So what are we going to cover in this video? Number one is why should you even listen to me? So there's a few points on my credibility. Number two, we're going to be talking about free gifts and added value. You're going to be getting some free stocks based on some of the promotions that we have going on right now. Number three is why should you invest in the stock market in the first place? The fundamentals of the stock market, so you know exactly how it works. Different types of investments, going over what a stock actually is. Number seven is why do companies even issue stocks to begin with? How are stocks categorized? We're going to understand risk. Risk is a big part of investing, and it's a must-know for every investor out there. Number 10, types of stocks and equities. We're going to be talking about what to buy. Number 11 is how to evaluate a company, reading different financial statements and ratios. Number 12 is the big one. We're actually going to be doing a live demo of buying a stock. This is going to be an actual purchase of a stock. And then number 13, we're going to be going over taxes and fees incurred with buying and selling stocks. Okay, so why should you listen to me? So at the time of this recording, I have over $391,000 invested in the stock market. This is not to brag, because to some people this is a big number, to some people this is a really small number. The reason I'm saying this is because I actually have my money where my mouth is, and I do have skin in the game. So this is just a snapshot of some of my portfolios here. The second part is I've been investing in the stock market for over 16 years. I'm 34 at the time of this recording. I've been investing since I was 16 years old. I started with a TradeKing account. Some of the older people watching this video may or may not remember TradeKing, but in this video we'll be using Moomoo. I also use M1 Finance, Vanguard, TD Ameritrade, and a few other brokerages as well. And then also, finally, I actually have a bachelor's degree in finance and entrepreneurship. I graduated in December of 2010 with a finance degree, and I've also worked in finance and commercial real estate a majority of my career. I've worked at publicly traded banks, publicly traded real estate investment companies, and I've also built, as you can see here in the third picture, homes from the ground up. So finally, I've been providing free value on YouTube since November of 2017. At the time of this recording, I have around 815,000 subscribers. So before we get started, there's free gifts and added value that I mentioned earlier. If you want to download this presentation for free, there's a link in the description below. You can download this entire PowerPoint presentation and rewatch it as many times as you want. No charge attached, of course. Free stocks, you can use the link below. In this video, we're going to be using Moomoo. This is the platform that I'll personally be buying and selling stocks with in this video. If you want to sign up with Moomoo, you can click on that link to get a free stock from them in the presentation, or you can use the link in the description below. And then finally, Whiteboard Finance University. If you want to join the waiting list, I will be creating a community that has courses, live Q&A with me once a week, so you can pick my brain to see what I'm buying, selling, career advice, pretty much anything you guys need, I'll be made available in this university. And then we'll also have a community Discord or chat room available. So let's get right into this. Why should you even invest in the stock market to begin with? Well, historically, it's been one of the best tools to grow wealth throughout human history. The market has averaged a 10% annual return on investment historically over time. And then the second biggest bullet point, which we're going through right now at the time of this recording, is high inflation. So you have to realize savers are losers. People that just save their money under their mattress or in their closet, that money is only worth its face value. It's not growing or working for you, even though inflation is increasing. So assets are more important than just having cash. You're actually losing purchasing power by not investing. So the current inflation is actually at 7.9%. There was just a recent study that came out that it's actually at 8.5%. So for example, if you're earning 0% in cash because it's just sitting in your closet or in a mattress and everything else is going up by 8.5%, that means you are losing that purchasing power year over year. Your money sitting in your closet can buy less and less over time. That's why it's paramount to start investing. Bullet point number 3, it's never been cheaper to invest. So $0 trades and fees are actually the norm. When I first started trading with TradeKing 16 years ago, it actually cost $4.95 a trade to buy and sell stocks. Just to be able to buy and sell, it's costing you $4.95 a trade. Now it's typically $0. So there's low expense ratios also for solid investments. These are provided through Vanguard and other big institutions, which we'll be talking about later in this video. These come in the form of ETFs, index funds, REITs. So if all these things are unfamiliar to you, we'll be discussing all this later in the video. And then finally, you don't have to be a genius to invest. You don't have to be someone burning the midnight oil and studying till 2 in the morning to find the perfect company. There are strategies that help you grow your wealth over time, which we'll be discussing in this video. So what are some common motivations of people wanting to invest? Well, people want to invest in order to build wealth. This is having your net worth increase over time. My channel focuses on this, and you know this if you've been watching me for the past 4 or 5 years now on YouTube. Some people, they invest to support a family. Some people invest to prepare for retirement. But the most important thing is bullet point number 2, which is setting attainable goals. You need to be specific. You can't go into this video or into investing thinking, I want to get rich, right? Well, that's not specific. If you want to retire with $1 million, now that's specific. That's a much more attainable and measurable goal. You need to have a certain time frame in mind. So parents in their 40s versus a single person in their 20s, they have much different time frames, okay? So the parents in their 40s may have 2 kids going to college, where a single person in their 20s may have, much more time and less responsibility in life in order to be able to invest more if possible. Finally, we have level of risk. So I like to call it my SWAN portfolio. SWAN stands for Sleep Well at Night portfolio. And then also you have high risk, high return, low risk, low return. Again, as investors, we are compensated for the level of risk we're taking on. And then finally, we need to set up an action plan to meet your goals when it comes to investing. So here's a quick fun number that we can play with. So how long would it take your money to double? So on the left column, we have your investment growth rate per year. So if your investments are growing at 4% per year, it's going to take 18 years in the right column for your investment to double. So if you put in 10 grand and your investment is growing 4%, it's going to take 18 years for that 10 grand to turn into 20 grand or $20,000. And then the higher the rate of return, the less number of years it takes to double. So if we look at the bottom column, or the bottom row, if your investment grew at 12% per year, remember the stock market has historically returned a 10% growth rate or return on investment historically. So if we take 12% per year, that investment or that $10,000 would take 6 years to turn into $20,000. Make sense? And then finally, why should you invest in the stock market? Well, it's because of compound interest. So I'm sure you guys have heard compound interest floating around on the internet, but if you're not familiar with it, compound interest is the interest on a loan or deposit calculated based on both the initial principal and the accumulated interest from previous periods. So your initial principal is just the initial amount that you invest or choose to take on. So think of this as your interest earning interest. So according to Albert Einstein, he used to say compound interest is the 8th wonder of the world. He who understands it earns it. He who doesn't pays it. This is just like you being late on credit card payments. It feels like you can never get your head above water because the interest on your credit card is so high. Makes sense? So at first, this quote might seem like a bit of an exaggeration, but the math behind it shows that it's not. So let's take a look at a compound interest example right now. Okay, so here's an example of compound interest. Let's say we have $10,000. We can either have this $10,000 sitting in our mattress or in our closet, as I mentioned earlier, or we can have this money working for us. So if we have $10,000, we're going to save it for 5 years, and we're going to have a rate of return of 5%. So after 5 years, our $10,000 turns into $12,763. So you're probably thinking to yourself, oh, big whoop, Marco, that's not even a big deal, right? Well, let's actually use the historical rate of return on stocks, which is 10%. So now that $10,000 after 5 years, by doing nothing, turns into $16,105. Okay, let's extend our time frame to 15 years. Well, guess what? After 15 years at 10%, your $10,000 is now 4x'd, and it's become $41,773. And let's say we're invested for 30 years. Let's say you start early and you want to save for retirement. Well, guess what? Our 10 grand earning 10% is now turned into $174,494. See how powerful that is? So if we go back to this, you can see why compound interest is so important and why investing is so important instead of just keeping your cash under the mattress. So now let's talk about the fundamentals of the stock market. So here's a quick history of stocks and the stock market or markets throughout the world. One of the first examples is in the 1600s, a Dutch shipping company called the Dutch East India Company sold shares of itself, which is equity. So we're going to be talking about equity, shares, and stock later in this video. They did this to raise capital to expand their business operations. In 1611, a stock exchange opened in Amsterdam in response to this demand of buying and selling shares of the Dutch East India Company. Today, stocks now trade on what we call exchanges. So a lot of this is going to be familiar to you. So here's some important exchanges in the United States and globally. So in America, we have the American Stock Exchange, Amex. I'm sure you've heard of this. This trades small caps, which we'll talk about later in this video, small market capitalizations, that's what that means, and derivatives. We're going to be talking about the CBOE, which is the Chicago Board of Options Exchange. They're the largest market for options, which I'm sure you've heard of. And if you haven't, we'll talk about that. NASDAQ stock market, this is tech heavy. This is where a lot of tech companies are traded. The New York Stock Exchange, which I'm sure everyone has heard of if you're watching this video. This trades more than 8,000 publicly traded companies, and it amounts for 30% of the world's trading. And then overseas, we have the Shanghai Stock Exchange, we have Euronext, and we also have the Japanese Exchange Group. So to put some of this in perspective, hopefully you guys can see this. You can see that each square on this chart is worth $100 billion. Yes, that's billion with a B. So you can see that the New York Stock Exchange in purple accounts for 31.5% of the world's largest stock markets, okay? And then we have the NASDAQ at 14.5%, and then the rest is totaling 89.5 trillion. That's all of them combined, but all the other exchanges total for 21.2%. So you can see how truly large the New York Stock Exchange and the NASDAQ really is. So moving on here, we have different types of investments. So there's stocks, there's bonds, there's mutual funds, there's ETFs, there's CDs. I'm sure you've heard of a lot of these, but what do they really mean? So very simply, this is just a high-level overview, and then we'll dig a little bit deeper later in the video. Stocks are just an ownership interest of a company. So we're going to elaborate on this much more in detail. Bonds, if stocks are equity, meaning they are owning an equitable portion of a company, a slice of a pie, which we'll talk about later, that means bonds are debt. So companies and governments, they issue debt via bonds. The bond issuers collect money from the investor at face value, and then they repay the investor back with interest semi-annually for a set period of time before paying back the principal. We'll talk about this later. Mutual funds are essentially when a group of investors pool the assets of all of their investments together to increase their buying power. And then we have exchange-traded funds, and then CDs, which are typically offered by savings and loans institutions, which we'll talk about later in the video. And then we have alternative investments or assets. We have commodities, which are typically oil, corn, soybeans. There's 100+ different traded commodities on different exchanges. And then we also have options, which allow investors to bet on whether shares will rise or fall in the future. So, for example, if I think a stock that is $50 will go up to $55 by a certain time period, I can purchase a call option on it. So there's hedge funds, so similar to mutual funds, but with more specialized strategies. We talked about mutual funds in the previous slide. We have precious metals, which I'm sure you've all heard of. This comes in the form of physical gold, silver, platinum, palladium, etc., etc. And then we also have collectibles. So these are types of alternative investments. We have cars, sports cards, art. These are very niche, however. You need to be an expert in this in order to make a profit. And then finally, we have real estate, which is a huge subset or an alternative investment to stocks. So let's go over what a stock is exactly. Okay, this is kind of where the rubber meets the road in the presentation. A stock is a share of ownership in a company. So think of each share being a slice of pizza. So if you have a piece of pizza that's, round, each slice is a piece of equity or a slice of a stock or a share of a stock. So buying shares gives you equity, aka ownership in shares of a company. So let's take Apple Inc., for example. So Apple, everyone's heard of Apple. There's Apple computers. I'm using an Apple MacBook for this presentation right now. Their ticker symbol, which is just those 4 letters to the right of Apple Inc., is AAPL. Every publicly traded company has a ticker symbol. So they have shares outstanding. So this is how many slices of the pie they have available to be eaten. Okay, so let's use that analogy. The number of shares they have is 16.39 billion. So that's a lot of zeros, which you can see right there. And at the time of this recording, the share price of Apple is $163.98. So when you take your shares outstanding multiplied by the share price, this gives you your market cap or your market capitalization. This is just simply shares outstanding multiplied by share price. So if we take 16.39 billion shares multiplied by $163.98 per share, we get a market cap of 2.68 trillion. You can actually see the full number to the right there. So companies are typically measured and categorized by their market cap. This is why it's so important. Market cap obviously changes over time because share prices and shares outstanding can change over time. So buying and selling a company's stock is what drives the share price. Makes sense? So in order to give you a better understanding, I'm going to go to the iPad here and use this Apple Pencil that I got. And I'm actually going to give you an example, okay? So if this is the pie that we're talking about, let's pretend that this is just some random company. We'll call it Company Marco, ticker symbol Marco, okay? So if this pie has 4 shares, or this company has 4 shares instead of Apple's 16.39 billion. Let's just do this for easy numbers. And each share, let's say, is worth $75 a share, okay? What is the market cap of this company? So let's use our formula. It's simply just the shares outstanding, which we know is 4, multiplied by the share price, which we know is $75 a share. So if we take 4 times 75, this equals $300, okay? So this company, this hypothetical company called Marco, is worth $300 as their market cap. Make sense? Okay, so now that we know how to calculate market cap, let's understand why do these companies even issue stocks in the first place. So corporations issue stocks to raise money for their business. If you remember the example of the East India Trading Company that we talked about earlier in the video, you know that they issued pieces of themselves in order to raise money for certain things. Well, in modern day companies, typically people issue stocks to fund a new product line, for R&D, for research and development, for investment and growth. This is what a lot of tech companies are doing over the past 5 or 6 years or so. And then also to potentially pay off debt. And there's 2 types of stocks. There's not just one stock, covers it all. There's preferred stock and there's common stock. Typically with preferred stock, you have no voting rights. So as shareholders, you have the right to vote on certain issues that come with investing in a publicly traded company. With preferred stock, you don't have those voting rights. With common stock, you do have voting rights. However, you are the last in line to get paid in case of a liquidation, and you're the last to get paid a dividend. So heaven forbid if a company that you invested in goes bankrupt and they need to liquidate, like Lehman Brothers, for example, preferred stock owners, they may get paid something, but common stock owners, they are last in line to get paid out. So you are usually buying common stocks when buying stocks. So when you hear someone saying, hey, bro, I bought some stocks in Apple, or I bought some shares of Apple, they're typically buying common stock. So if we go back to the presentation, there's different ways that stocks are categorized. This is important, so please pay attention. We typically have large cap, mid cap, and small cap stocks. The reason for this is because we're going back to that calculation of market cap. There's shares outstanding times share price, which we went over just a couple minutes ago. So the way these are classified is typically large cap. So this would be a company like Visa, for example. This is when their shares outstanding times their share price equals $10 billion or greater. Typically, this is hard to achieve massive growth due to their size. So these are more mature companies or companies that have been around for a while, for example. These companies have a proven track record over many years, and they frequently offer dividends. Then we have mid-cap stocks. This is their market cap of $2 billion to $10 billion. They're not quite as large caps, and they're more established than small caps, if that makes sense. These companies are often the target of mergers and acquisitions for wanting to be absorbed into another company to grow a certain product line, for example. And then we have small cap, which is $300 million to $2 billion in market cap. These are typically younger and seeking aggressive growth. These are the companies that want to grow, typically disrupt an industry like Uber, for example. And then they're higher risk and don't usually offer dividends because they're, instead of paying out a dividend because they're not as established, they want to plow back all that money into research and development. So how are these stocks categorized? So if you guys are familiar with any of your, retirement accounts or 401k accounts, typically you've seen this Morningstar style box. So in the bottom left, we have value, we have blend, we have growth, and then on the column going up and down, we have large cap, mid cap, small cap. So if you're typically looking for a combination of these two, and you'll understand if you're getting into a stock that is value-oriented, a blend of growth and value, or typically growth-oriented, and you'll be able to see if it's a small cap stock, a mid cap stock, or a large cap stock. Make sense? So if we go into growth stocks, these typically have big potential for growth. They may outpace the market. So lately, over the past 5-10 years, we've seen companies like Amazon crush it, Microsoft crush it, Tesla is absolutely crushing it. I actually did a video in April of 2018 talking about my favorite stock for 2018, and it was actually Microsoft. And at the time of that recording, I believe Microsoft was sitting at $96 a share. Now it's sitting at like close to $300 a share. So it's pretty interesting what can happen in 4 years. So typically, growth stocks offer low or no dividends because, as I mentioned earlier, they're reinvesting those retained earnings in order to keep growing, such as Amazon. Amazon is a perfect example of that. Second, we have income stocks. So income stocks are a regular dividend payer. These are your 3Ms, your Waste Managements, your Verizons, AT&T, for example. They have a proven track record or business model, and they consistently increase their dividends. If you want to watch my dividend portfolio criteria video, download the presentation and click this link. It'll take you to my video to show you exactly how I invest in income-producing stocks or dividend stocks. I've been doing that for 105 weeks now, and I've been updating that every week in the community tab of my channel. That portfolio is now sitting at like $35,000 at the time of this recording. And then finally, we have value stocks. So these are perceived to be trading below its fundamentals, which we'll talk about later in the video. We'll go over all these ratios. We have the PE ratio and we have the PB ratio. This will be described later. And then typically, value stocks are seen as unfavorable in the marketplace. So the best analogy I can give you is value stocks are seen as a dog with fleas. But if you end up taking that dog home, washing it, cleaning it, aka bringing in better management, better product lines, better use of capital, there's a lot of value to be gained, meaning you can get a companion for life. So that's my cheesy analogy of a dog with fleas turning into a great best friend for value stocks. So how are stocks categorized? Continued. We have stock sectors. This is very important, so please pay attention. This is an area of the economy in which businesses share a product or service. So typically, there's 11 broad sectors. We have energy, we have materials, we have industrials, we have consumer discretionary, we have consumer staples, healthcare, financials, IT, aka tech, telecom, utilities, and then real estate. You can always pause the video right here to look at the specific examples, but these are the 11 broad-based sectors in the economy. So we need to understand risk. Understanding risk is paramount. This is the whole point of being an investor. If you take anything away from this video, understand this. You are compensated or should be compensated for the amount of risk that you take on as an investor. So let's describe what is risk. So the risk is the chance that your actual outcome will differ from your expected outcome. So if we had a 100% guaranteed investment earning 7% per year, guaranteed, I would put every single penny that I have into that investment because it's guaranteed, right? As long as you're outpacing the rate of inflation, for example. But that's beyond the scope of this video. So if you told me, hey, Marco, I'm going to make you a guaranteed rate of return of X, let's say it's 10%, I would invest everything I had into that investment because there's no risk. However, We live in the real world where risk includes the chance of losing some or all of your investment. So risk should be reward, as I mentioned earlier. As investors, we are compensated for the level of risk that we assume. For example, there's a much higher chance of bankruptcy if you're investing in a startup, or a higher chance of not making any money as a startup versus a savings account, for example. That's why your savings account right now is earning 0.4%, whereas investing in a startup could, make you a multi-millionaire, depending on the company. So that's the different spectrums of risk. So there's different types of risk, and it's important to understand this, especially in today's market, especially at the time of this recording. There's market risk. These are different economic developments or other events, such as the Fed raising interest rates, for example. We have liquidity risk, where you can't sell your investment. So say, for example, so let me back up. Liquidity is just something that means, hey, I can easily sell stocks and bonds. I'm very liquid. Or I have all my money in a savings account. I'm very liquid. What isn't liquid would be if you owned a commercial real estate building in the middle of Alaska, that caters to, only a certain demographic, right? That's very illiquid because there's only a certain type of demographic or person that would want to buy a commercial real estate building, sitting in the middle of Alaska, right? So that's liquidity risk. You can't dispose of it quickly. There's concentration risk. You have too many eggs in one basket. So say, for example, I wanted to own 99.9% of my net worth in Tesla stock, right? Well, that could be very high reward, but it could be also very high risk because I'm concentrated all just in that one company. So that's concentration risk. Number 4 is credit risk. So the entity can't repay. So say, for example, you're issued a bond by a company or by a municipality, and that company or municipality goes broke. Well, guess what? You're now part of credit risk because you're not going to get paid back your principal or your par value because that entity simply can't afford it. This would be like loaning money to your broke friend who is never going to pay you back, right? You're open to credit risk. Number 5 is inflation risk. So this is the loss of purchasing power. So for example, we talked about how inflation is actually sitting closer to 8.5% year over year at the time of this recording. So that means that if your investments are earning 3%, let's say in a very conservative stock or a bond, for example, and inflation is 10%, you are losing 7% per year in purchasing power because your investment is only earning 3%, inflation is outpacing you at 10%. Makes sense? And then finally, we have number 6, which is horizon risk. Your investment time frame changes. So say, for example, you're putting all your money away for the down payment of a house, right? You want to save 20% down payment. You're putting it in really risky stocks, and your down payment goes to 0. Okay, so now you just lost your entire down payment of your house, and now your horizon has to change. Okay, so your investment time frame changes. It may go from a year to 10 years, or from 10 years to 3 years. It all just depends on what your time frame is. And then finally, we have foreign investment risk. This applies to foreign investments. So say, for example, at the time of this recording, there's a conflict going on in Eastern Europe between Russia and Ukraine. Say, for example, all your portfolio was in Russian rubles and those collapsed, right? So that's what we call foreign investment risk. Or say you want to invest in a startup company in North Korea and that company gets shut down just because. Well, that's risk that you have to get prepared for. Okay, so moving on to different stocks and equities, what to buy. These are just the different categories. We'll be breaking these down individually, so I'm just going to name these very quickly. So number 1 are individual stocks. This is exactly what it sounds like. You are investing in individual companies such as Microsoft, Apple, 3M, Waste Management, Verizon, doesn't matter. We're just using this as an example. Number 2 are mutual funds, such as BlackRock, which we'll break down further later in this presentation. Number 3 is index funds, which are offered by Vanguard and many other brokerages out there. Then we have exchange-traded funds, which are ETFs provided by Fidelity and Vanguard and a bunch of different funds out there. And then also REITs. This stands for Real Estate Investment Trust, which we'll break down in a little bit. So let's dig into types of stocks. So individual stocks. The pros are that there's reduced or essentially no fees involved in owning these stocks. And then also there's no management fee to own them, and there's no fees to trade them, which we'll be talking about and showing you later in this video. So you have complete control or understanding of what you own. You know that you're buying X amount of shares of Tesla, X amount of shares of Walmart, X amount of shares of Apple. So you have complete understanding of what you own. And the taxes are very easy to manage. So we can either incur a capital gain or a capital loss for the most part, which we'll talk about at the end of this presentation. Some of the cons with individual stocks is that they're hard to diversify with. So like we talked about with concentration risk, let's say I own 99.9% of my net worth is in Tesla. Well, I need to be more diversified if I want to sleep well at night. Who knows what's going to happen to the future of a certain company, right? So you need at least 20 to 100 different types of individual stocks in order to achieve adequate diversification, in my opinion. This takes more effort or time to monitor this portfolio when it comes to rebalancing, making sure you don't own too much of one position, for example. And then also you can be susceptible to FOMO or emotions. FOMO simply stands for fear of missing out. So I'm sure you've seen this over the past couple of years where people are like, dude, you got to buy X company. You got to buy Y company. They're absolutely crushing it, dude. You have to buy this. Or you overhear something in the locker room, at a rec center, for example. That's called FOMO. You have the fear of missing out. So let's talk about mutual funds now. So mutual funds, they are pools of money from the public in order to buy securities. So think of this as almost like crowdfunding. So you pool together a bunch of people's money in order to obtain a certain objective to invest in it. So the pros of a mutual fund is that they're very liquid, they're very diverse, they own a lot of different holdings for the most part. They're typically professionally managed. So we have active management where an actual human being is managing the portfolio versus a passive mutual fund where it could just be an algorithm or it could be updated maybe just, once or twice a year. This is not actively managed by a human. It's called passive management. And then we have a lot of options. So there's balanced mutual funds, fixed income mutual funds, which we talked about earlier, money markets, income, all that stuff. So you have a lot to choose from. Some of the cons, though, are that the fees are higher. Typically, this comes in assets under management. So if you have, let's say, $100 in a mutual fund, their fees may vary anywhere from like 1% to 5%. So it may cost you anywhere from $1 to $5 per year just to be able to invest in that mutual fund. Now, if you have $1 million, it's going to be 1% to 5% of $1 million, so on and so forth. Typically, they have large cash holdings, meaning that cash is kind of just sitting there. We talked about this with the cash sitting under the mattress analogy or the sitting in the closet analogy, which is not actively being used. And they have this for reserves. They have it for strategic purposes, so you can't really blame them, but it is a con. And then you have hard to evaluate. So you can't really evaluate apples to apples, mutual fund to mutual fund, just because they are very unique in what they invest in. So moving forward, we have index funds, which is a basket of stocks to mimic a certain market index, as I mentioned earlier. The pros of this are that the fees are very, very, very low. So with the mutual fund, your fees are going to be 1% to 5%. With index funds, it could be as low as 0.03%. Okay, I'm talking 3 basis points. It's a fraction of a percent. So they typically outperform active management over time. There's been a bunch of studies that show this. They're very easy to own, manage, invest in, and use to achieve your goals. I have a significant portion of my net worth in index funds and ETFs just because they're very easy to use and invest in. Some of the cons are that you don't really have control over the holdings, so you can't really influence management. You're not a shareholder. You're not a member of the board, for example. You're not the portfolio manager, so you really have no say in what's being invested in. You're just hoping that the manager is responsible and he's a fiduciary to your money and he's going to be investing in what's it's supposed to track, which is typically a certain market index. There's a lack of downside protection because it's not a hedge fund. So if you guys remember the crisis going on just in March of 2020, a lot of people, they lost a lot of money in the market, maybe 30, 40, 50%. But hedge funds only lost, 15, 20%, for example. That's because they're hedged to the downside, which index funds are not. And they also lack different strategies. That's because they're just trying to mimic an index. So ETFs are very similar. They're a basket of stocks to mimic a certain market sector that trade on an exchange. So you have access to many stocks, you have very low expense ratios, and just like index funds, they're very easy to own, very easy to manage, very easy to invest in. Some of the cons are that actively managed ETFs have higher fees. These are similar to mutual funds, that are actively managed. You have a lack of downside protection. Again, it's not a hedge fund. And then also diversification is limited because you're only focusing on one market sector or one industry because you're tracking an exchange. And then finally, we have REITs, which stands for Real Estate Investment Trust. This is a company that owns, operates, or finances income-producing real estate. So they historically have access to an inaccessible asset class. So meaning that, unless you're a high net worth family or a high net worth individual, you're not out here buying office buildings and strip plazas and strip centers and all that stuff. Those are typically reserved for people with a higher income. The other pro is that REITs are traded just like stocks. That's why they're in this presentation. They're liquid, meaning that we talked about liquidity. They're very easily tradable. You can buy them, sell them very quickly. They have stable cash flow through dividends. That's what they provide. The reason for this is because legally REITs have to pay out 90% of their income, okay? That's literally the law. So they typically pay out very high dividends. Historically, real estate is a very sound asset class, and historically, real estate has produced some of the highest wealth in human history. However, some of the cons of buying and selling REITs are that the dividends are taxed as regular income, which we'll talk about at the end of the presentation. They're subject to market risk. So if you remember the economy turning down in 2008 after the great financial crisis, a lot of real estate lost, 30, 40, 50, 60% of its value, within the span of 6 to 12 months. And sometimes these REITs can have high management fees that they charge. Okay, so now here's where some more rubber meets the road in terms of how to evaluate a company. So we're going to be looking at financial statements. So I come from a traditional finance background. I have a finance degree. I used to do this for a living. This is important because a lot of people, when they're investing in stocks, they just go for kind of like the, what stocks are sexy and, what's cool, but they never look at the numbers. They truly don't even know what they're buying. They just go by the name and what the company's doing, and that's a very sophomoric or rudimentary way to invest, okay? So financial ratios, where do these numbers come from? So they come from essentially three things: the balance sheet, the income statement, and the cash flow statement. So what do these mean? So the balance sheet is typically your assets equaling liabilities plus shareholders' equity. So what are the things that the company owns that have value? They should be equal to the liabilities. This could be accounts payable, for example, plus shareholders' equity. We'll break this down further later in the video. So income statement. This is the revenues and the expenses during a specific period, okay? So you have your net income totaling your total revenue plus gains minus your total expenses plus losses. That's your net income. So it's basically money in, money out. How much did I make after all the money I spent this year? Number 3 is cash flow statement. So this is your cash inflows versus your cash outflows. This is no different than a diet. You have your calories coming in, you have your calories going out, your calories being burned. So this comes from 3 things. You have cash flow, your operations. This is your business activity, things like that. You have investment cash flow. This is your PP&E, property, plant, and equipment. CapEx, which is capital expenditures. And then finally, you have financing. So this is the cash flow between a business and its creditors, which can be seen in a 10K. So there are 5 financial ratios when buying stocks that you should be looking at. You have valuation ratios, you have profitability ratios, you have liquidity ratios, you have debt ratios, which shows solvency, meaning is a company solvent, meaning are they able to service their debt, aka can they pay back what they borrow? And then 5, you have efficiency ratios. So we'll be going over that right now. So the most common ratio, which there's going to be some asterisks or asterisks is in this presentation. This one is the price to earnings ratio, okay? This is considered a valuation ratio. So a PE ratio is simply a company's share price to its earnings per share. So this is relative value of a company's shares, apples to apples. So if you remember how we talked about how mutual funds are hard to make an apples to apples comparison on, that's because they're very different. They invest in different things, they have different objectives. But when you look at 2 companies, you can get an exact idea of the company's relative value of their shares versus their earnings per share, if that makes sense. So the formula is market value per share divided by earnings per share. So let's give you a live example right now. Okay, my friends, on the screen right now we have Finviz, finviz.com. I highly recommend you learn this site because this is a great way to get you all the financial visual information that you need to be a successful investor. There's a lot more that the site offers, but right now we'll just be using Apple as an example, okay? So right now we have Apple. We're looking at their chart right here, which I can explain later. But remember, right now we're just trying to figure out the PE ratio, okay? So right now we can see the answer to this question is that Apple's PE ratio is 27.44, okay? So how did we come up with that? This is market value per share divided by earnings per share. So if we look at some of these things are going to be a little bit outdated because right now the market, I think it just closed at the time of this recording. So these numbers may not be updated. But if we just do simple math right here, we're going to take the market value per share. So we know that Apple right now is trading at $165.29. Okay, so we're going to take $165.29. And we're going to multiply that, or excuse me, we're going to divide that by the earnings per share, 6.02, divided by 6.02. That gives us 27.45. So if we go back to Finviz, we can see here our PE ratio, we are correct, 27.44. Okay, and these numbers are going to be off just a little bit, but you get the idea. So if we go back to this, a healthy PE ratio should sit at 15 or lower. And the reason there's an asterisk right here, ladies and gentlemen, is because there's a lot of things that go into the economy and into stocks that have affected share prices over the past, I'd say, 12 to 15 years or so. And that is there's been a lot of money printing, okay? A ton of money printing, a ton of cheap debt. That is outside the scope of this video, but you need to take all of this with a grain of salt. So traditionally, if you're Warren Buffett, they typically looked for companies that were value companies. So PE ratios of 15 or lower, that's what was considered healthy, back in the day. Now, no serious investment or investor, holds PE ratio with too much grain of salt, but it's important that you understand how to calculate it and understand it. So don't regard this healthy number just as much. It used to be more relevant, but now it's not. So moving forward. So price to earnings to growth ratio, okay? This is what we call a PEG ratio. This is a valuation ratio. So the PEG ratio is a company's share price to its earnings per share growth. So this is basically making an apples to apples comparison of a company's stock value factoring the amount of growth they have. So this formula is price divided by earnings per share divided by earnings per share growth. Earnings per share growth is simply just an estimate. So we'll give you a live example of that right now. Okay, so we're back on Apple on Finviz. So the nice thing about Finviz, to be honest with you, is that they already give you all these answers. So we already know that the PEG ratio is 2.67. And since it's colored red, we know that it's somewhat unhealthy. You can see here that they already make things in green. Black is neutral. Red is AKA bad, kind of. So the whole point of this video is for me to teach you how to do this. Anyone can just look up the answer, but that doesn't mean that you understand what you're doing. So if we take the PEG ratio, remember, the PEG ratio is simply just price divided by earnings per share, aka the PE ratio. We already did this. So this was the answer from the previous slide for the PE ratio. And we simply divide this by the earnings per share growth. So since you want to use an estimate, a long-term estimate, which is typically the next 5 years, we can see here that their earnings per share for the next 5 years is projected to be 10.28%. So the formula is just price divided by earnings per share, that's this number right here, divided by 10.28, the percentage. What do we get? 2.67. Oh, look at that. PEG ratio, 2.67. Ta-da! We're right. So that's how you figure out the PEG ratio, guys. So let's go back into the presentation. We'll look at our next ratio. It's important for you guys to understand this. I know this is kind of boring for some people, but it's important to understand these ratios. Next, we have price to book ratio. This is another valuation ratio. So a PB ratio is a company's market cap to its book value. This compares the cost of a stock to the value of its equity if the company was sold today. So this is the stock to assets value. So the formula for this is simply the market price per share divided by book value per share. Book value broken down is your total assets minus your total liabilities divided by shares outstanding. We talked about Apple's shares outstanding earlier in this video. So let's give you a quick live example. So if I go back to FinViz, we can already see that the answer is right here, 37.65. That's the price to book ratio. However, we need to figure out how this works. We need to actually be practitioners and understand these calculations. So I'm going to take the market price per share, which we already know is 165.29. So I'm going to go to my calculator. Apple's price per share, 165.29. And what we're going to do is divide that by book value per share. So if we go back to FinViz, you can see here that the book value per share is 4.39. So if I go back to the calculator, divided by 4.39, voila, 37.65. What was the answer according to FinViz? Price to book ratio, 37.65. See how easy that is? So a lot of these ratios are going to be common sense, or not common sense, but it's going to be basic math. However, it's important that you understand what you're doing and why you're doing it. So take a moment during this presentation. If you download it, again, you can download this in the description below. You need to be able to download this stuff and understand and calculate these metrics yourself. So if you look at a healthy PB ratio, again, there's an asterisk right there because, who knows what's really considered healthy in these days. It's typically 3 or lower. And if you go back to FinViz, you can see here that they're sitting at 37.65, which is why it's red. But again, Apple's a tech company. They pay a good, decent dividend. They've been around for a while. There could be reasons for these valuations being a little bit out of whack. Okay, so the next metric on how to evaluate a company with a financial ratio comes down to ROA. ROA is simply your return on assets. This is considered a profitability ratio. So ROA simply tells you as an investor how profitable a company is compared to its assets. So this gives an investor an idea as to how efficient a company's management is at using its assets in order to generate earnings. So this formula is very simple. So if you just go down to the next bullet point, you can see here that it's net income divided by total assets. So we'll give you a live example right now. So if we go back to FinViz, you can see that the answer already is going to be right here, as with most of these ratios is in FinViz. But again, we're practitioners and we want to know how to come up with this number ourselves. So the answer that we're looking for is 28.7% or somewhere close to it. So if we go to FinViz, you can see here that if we look for net income, you can easily find that right here. It's just called income, and they're sitting at $100.56 billion in net income. But if we didn't have this, we would actually scroll down, and you can see here that FinViz actually provides you with income statements, balance sheets, and cash flows of these companies, which is pretty cool. This is very powerful stuff, you guys. So if we didn't have the answer for income up above, which I just showed you, we would come to one of these 3 statements. So if you had to guess, where is net income going to be on these statements? Is it going to be on the income statement, the balance sheet, or the cash flow statement? Obviously, it's going to be at the income statement because we're looking for net income. So if we scroll down, you can see right here, we have net income right there, and we're going to have 3 different time periods. What you want to use is the last 12 months. You want to use trailing 12 months. So you can see here that they have September 26th, 2020, September 25th, 2021, and then right here, we have TTM, that stands for trailing 12 months. This is the metric that you want to use. So if we go down to net income, we can confirm that we are looking at 1.56 billion right here. It's not 100,555. You have to add on zeros that make it a billion. They're just doing this to shorten the number here. So we confirm that. So now we need to figure out what total assets are. So what did we discuss where we talked about where it's kind of like a snapshot of the company? Well, the snapshot comes from the balance sheet. This shows you at any given point in time, you can see exactly what the company has in terms of, cash, inventory, assets, things like that, accounts payable, receivable, liabilities. But what we're looking for is, remember, total assets. So we see that number right here. I'm going to use the most recent column, which is coming back at 351,002. So let's take these 2 numbers and put them into a calculator. So we're going to do this. We're going to take, I believe it was 100.56 28.56 billion. Remember, that's our net income divided by total assets of, we'll do 351.002, okay? 351.002, which gives us this number right here, 0.2865. Now, if we multiply this, remember this is a fraction. We need to multiply this by 100 to get our percentage or our number. You're going to get 28.64%, okay? So if you go back up to ROA percentage, 28.7 is the answer here. So we're close enough. Remember, these prices and numbers change all the time on Finviz. We're not going to be 100% accurate, but you can see here 28.65, 28.7, same thing. That's how we figure out ROA. Make sense? So now let's go back to the presentation. We're going to look at a couple more valuations. I know, again, I mentioned this could be kind of boring to you, but again, this is paramount that you understand this stuff before just clicking buttons and starting to buy stocks left and right without even knowing what you're doing, right? So the next slide is going to be ROE. This is return on equity. This is, again, a profitability ratio. ROE measures how efficient a company is at generating profits. So this gives an investor an idea as to the profitability of a company in relation to the stockholder's equity. So this formula is very simple as well. This is simply net income divided by shareholders' equity, and we'll give you a live example right now using Finviz. Okay, so this one's going to be a little bit tricky, and I'll show you why. Remember, we have to line up the time periods to get the right numbers. So ROE, right away, we can see the answer here is about 150%, okay, 149.8%. So according to the last slide, we would have to go and either look at this, which we have net income. Remember, we're looking at net income divided by shareholders' equity. So your first inkling or your first instinct is to go back to using 100.56 billion. But I'll show you why this one's a little bit different, okay? And this is where you have to pay attention if you're being a good analyst. So remember, we have to use the same time frames for the same ratios. So if we go to the balance sheet, we are looking for shareholders' equity. So if you look at total equity, you can see here that for this column, it is 63.09 billion, okay? So if we scroll back up, you can see that this time frame right here is September 25th, 2021. Now, if we go back to the income statement, you can see that the net income here is trailing 12 months, okay? So for this one, we're actually going to use this net income right here, which is 9/25/2021. And I know it's a little bit confusing because I did use trailing 12 months for the previous ratio. This is just one of those things that you have to have experience with or massage to understand why this is going to be right, and I'll show you why it's right. So we're going to actually take this number right here. We're going to take the net income of 94.68, okay, which you can see right here. So I'm going to put that in the calculator. 94.68, that's our net income divided by shareholders' equity. So if we go back to the balance sheet, you can see here that the total equity for this time period is 63.09, okay? So if we go back to the calculator, 63.09, we should get 150. There we go. We have 1.5 times 100, 150%. So if we go back to Finviz, we can see here, sorry for all the scrolling and stuff, I'm just trying to get back up here pretty quick, that the ROE is indeed 149.8. So we're close enough. Remember, Finviz, the prices and things do change. Sometimes it's not 100% up to date, but this is close enough. So we're basically right with this ROE. So if we go back to the presentation, again, the formula for return on equity is simply simply net income divided by shareholders' equity, and this just gives an investor an idea as to the profitability of a company in relation to their equity. So a healthy ROE for this one, again, we have an asterisk. It's just subjective to the industry that they're in. So tech is going to be different than consumer goods, for example. Okay, so the next financial ratio is the current ratio. This is a liquidity ratio. This basically shows you the ability of a company to be able to pay its short-term obligations or those due within 1 year. So this gives an investor an idea of how a company can maximize the current assets on its balance sheet to satisfy debt or payables. So this formula, again, is very simple. It's just current assets divided by current liabilities, and we're looking for a healthy current ratio of at least 1.2 to 2. Again, there's a little asterisk right there, which you get the picture already. So let's go into Finviz and try and figure out Apple's current assets divided by their current liabilities. So we can see in Finviz, the current ratio is coming in at 1.0. So that's why it's black. It's not super unhealthy, but it's not measuring up to our 1.2 to 2. And let's see how we can figure this out. So again, we're looking for current assets divided by current liabilities. So which one of these statements right here out of these three, remember we're looking at income statement, balance sheet, and cash flow, which one do we say is a snapshot in time of the company's current balances? Obviously, the answer is going to be balance sheet, right? So if we look at, we're looking for total current assets. So if we use 925.21 as the column that we're looking at, we can see here that they have 134.836 billion. So we're going to put in 134.836 divided by current liabilities. So remember, assets, liabilities. Right here, we have total current liabilities. We're coming in at 125.481. So 125.481. And we're actually coming in at 1.07, which you can see right here, which is going to be a little bit higher than what FinViz is telling us. So FinViz is telling us 1.0. So again, there may be some small discrepancy in the data, but for the most part, as long as you're doing the calculations correctly, you are getting the right answer. So 1.07 is actually the correct answer. So let's go back to the presentation. Again, we were shooting for a healthy current ratio of 1.2 to 2, but again, Apple has a ton of cash. They are a healthy company. This depends on industry. So if we move forward, we're going to do the quick ratio as well. This is very simple. This is also a liquidity ratio. This measures the company's capacity to pay its current liabilities without needing to sell inventory or get more financing. This is considered more conservative than the current ratio, which we just solved for. So this one is going to be your cash plus marketable securities plus accounts receivable divided by current liabilities. So a healthy ratio or a healthy quick ratio for this one is 1-to-1, which when we saw FinViz, we already know that 1 is considered healthy right here for a quick ratio. So let's dive in and do the math on this one and figure it out. Okay, so you know the drill. We're going down to FinViz. We're going back down to the balance sheet because it's a snapshot. We're seeing the cash, the marketable securities, and the accounts receivable. Remember, the formula for the quick ratio is cash. So we're going to do cash and equivalents, marketable securities, that's short-term investments, cash and short-term investments right here, and then we have accounts receivable net, okay? So let's take a look at this, and we'll actually add all this up. This may be a little bit of pain in the butt, so we have to go back and forward, but let's do it. So we're going to take 17.635, okay, 17.635 plus, that's just this number right here. Short-term investments, 27.699. 27.699 plus cash and short-term investments, 62.639. 62.639 plus, we're going to do accounts receivable. Okay? Accounts receivable is 26.278. 26.278. That gives us a total of 134,251,000,000. But let's just do 134.251 for easy numbers. And remember, we're going to divide this by our current liabilities, okay? That's what we're trying to solve for. So if we go to current liabilities, we already figured this out. It's 125.481. 125.481 equals 107. Okay, so we're a little bit high again because remember FinViz is saying that it's supposed to be 1-to-1, but we're close enough. So again, these numbers may be slightly off. They may be looking at another column that I may not be accounting for, but trust me, we're close enough, and this is the right way to do it. Again, it's cash, short-term investments. That's considered marketable securities. Cash and short-term investments, accounts receivable, okay? Okay, so the next ratio is the debt to equity ratio, aka the debt to solvency ratio. No one really calls it that. It's mostly the debt to equity ratio. So this is simply going to be a measure of a company's financial leverage. So this is showing a measure of the degree that a company is financing its operations through debt versus wholly owned funds. So this is no different than, to give you a real estate example, let's say a property is $100,000, an investor wants to put down $20,000 of their own cash, they're getting an $80,000 mortgage on a property that's worth $100,000. Their debt to equity would be 80 divided by 100, okay? So that's their debt to equity. So we're going to show you the formula for this. It's going to be the total liabilities divided by the total shareholders' equity. And the example is going to be on the next slide. And remember, a healthy debt to equity ratio is typically 1-to-1, again, with the asterisks. So if you look at the debt to equity ratio, you're going to look at total liabilities divided by total shareholder equity. This is what you owe versus what the shareholders own. So if we took a company 1, which has a 5 debt to equity ratio, you can see that they have $100,000 in business loans divided by $20,000 in retained earnings. So if you have a 5 debt to equity ratio, remember we said ideally 1-to-1 is healthy. This is going to be a highly leveraged and risky investment. Now, if we look at company 2 with a 0.5 debt to equity ratio, you can see that they have $50,000 in outstanding business loans divided by $100,000 in retained earnings. So this would be considered a low risk company and quote unquote a better investment. So whatever, I mean, you can't just call it a better investment because this company right here, company 1, may be a startup company. They took on a lot of debt, but they're going to be the next unicorn in 10x or 100x. As to where company 2 may be kind of like a dividend or an income stock, like a 3M, for example, that is low risk. It may be a better blue chip company, but it may have much smaller upside, as well as much lower downside or higher downside, whichever way you want to phrase that. You may not lose all your money as opposed to investing in like a highly leveraged company, for example. So that's all, the verbiage you want to use. So, sorry, we do have a couple more ratios. We do have the asset turnover ratio. This is an efficiency ratio. So asset turnover ratio, this shows you the measure of a company's ability to use its asset to generate sales or revenue. So this shows you the degree at which a company is financing its operations through debt versus wholly owned funds. So the formula for this is total sales divided by beginning assets plus ending assets divided by 2. So again, we're going to show you an example on the next slide here. So healthy asset turnover is considered, a higher number is more preferable. But again, it's all company specific, industry specific. So we can see here we have 4 companies. We have Walmart, Target, AT&T, and Verizon. We're going to see their beginning assets right here in the y-axis. You're going to see the ending assets right here in this column. Average total assets, revenue, and asset turnover ratio. So we're going to see Walmart, who has 199,581 in millions, so you have to add 6 zeros to this number, but let's just call it 199,000 for easy numbers, in beginning assets. Then they have 198 in ending assets with an average total number of assets of 199,203. With revenue of almost $500,000. Their asset turnover ratio is 2.3. Now, Target, these numbers are going to be a lot lower, okay? So you have 40,262 in beginning assets, 37,431 in ending. Average total assets is going to be 38,846. The revenue is going to be close to 70,000. The asset turnover ratio is going to be 1.79. You have the AT&Ts of the world, where they have a ton of assets, decent amount of revenue. Same thing with Verizon, and these ratios are going to be much, much lower. So remember, the higher number is more preferable. This is just measuring the company's ability to use its assets to generate sales over revenue. This shows me that Walmart and Target are generating much higher sales compared to its revenue than AT&T and Verizon are, okay? So this is going to be beyond the numbers. So I've talked a lot about the numbers. Let's go something that's beyond the numbers now. So what the statistics don't tell you. So you've boiled down your search to a few companies based on numbers, the ones that you've learned in this presentation. You've eliminated a lot of the bad apples. You eliminated all the speculative companies, all the penny stocks, all the TikTok recommendations out there, and you're actually, picking a few companies that have narrowed down to the criteria that you're looking for. So stats rarely tell the whole story. If you guys are a little bit older, you may remember Enron, WorldCom, more recently Luckin Coffee, the Chinese company. These were companies that were actually literally found out to be frauds, okay? So you need to understand that statistics are one thing, but books can be cooked, although it rarely happens with publicly traded companies, but it does happen. But you need to understand how to analyze a company beyond the numbers. So here's 5 quick steps. So you have to keep up with the news about stocks you own. Okay, so you have to understand what competitors are doing. So for example, if you're investing in Tesla, well, it would behoove you to understand what Rivian is doing, what other electric companies are doing, electric vehicle companies are doing. What is Ford doing? How are the big legacy manufacturers innovating in the EV space, right? So you can't just be super confident that Tesla is always going to be number one in the EV category. So you need to keep up with the news about stocks you own, about competitors, and then also internally what's going on inside the company. Number 2 is media outlets have their own agendas. So if you look like, for example, you have to take everything they say with a grain of salt. May actually be pumping IPOs. Same thing with like and stuff. You never know what the own agendas are of these people. You need to do your own due diligence. I'm not saying that, I'm just using them as an example, but you need to do your own due diligence. So number 3 is never invest based on hot stock tips. So do your own diligence on this as well. Just because you're at the locker room at the rec center and someone's saying, oh, stock XYZ is going to go to the moon, don't just smash buy. Don't just jump on Robinhood or Moomoo and, smash buy these stocks. You need to actually do your own due diligence. That's the whole point of this video. Number 4 is tracking and maintaining your own portfolio. You need to trust your own process and your own thesis. So if you're buying 10 different individual companies, you need to inherently understand that 4 or 5 of these are going to be most likely duds. A few more are going to barely keep up with an index fund or an ETF. One may outperform and then the other may be a unicorn, that 100x's, for example. So you need to track and maintain your own portfolio at all times. And then finally, number 5, don't overreact to the news. There's always going to be times of war, especially at the time of this recording right now there is. There's going to be times of insolvency. If you remember the Greek debt crisis, the Cyprus bail-ins, 2008, dot-com bubble, there's going to be periods of insolvency as well. You just need to stay the course and remember number 4, trust your process and your own thesis. So now is the time of the presentation that you guys have all been waiting for. The trading app that we'll be using in this video is Moomoo, which is a commission-free mobile trading app available on Apple, Android, and Windows devices. The reason I'm using Moomoo is that it is a great alternative to other brokerages such as Robinhood and Webull. It's a commission-free trading platform for U.S. stocks that allows you to buy stocks, options, and ETFs at a low cost. So Moomoo offers impressive trading tools for both beginner and advanced investors. Some of the features include advanced charting, pre- and post-market trading, international trading, research and analysis tools, and most popular of all, free level 2 US market data, which we'll get into later in this video. So if you aren't familiar with Moomoo, it's an online trading platform offered by Moomoo Inc., which is based in Silicon Valley, California, is an indirect, wholly owned subsidiary of Futu Holdings, which is a NASDAQ-listed company. So securities, products, and services on Moomoo are offered through Futu Inc., an SEC-registered broker-dealer, and a member of FINRA/SIPC. I like Moomoo because it's a platform that you can start using as a beginner and grow into over the years as you become more and more experienced as an investor. We can place simple buy and sell orders, but also start using more and more of Moomoo's advanced research and trading features down the road. You can also use Moomoo on many different platforms because they offer both PC and mobile applications. If you want to use Moomoo on your desktop and link it to as many as 10 HD monitors simultaneously, you can do that. If you want to place a trade or use the platform on a mobile device such as your phone, you can do that too. Moomoo offers advanced charting, smart orders, longer trading hours outside of the traditional 9:30 a.m. to 4 p.m. Eastern Standard Time trading hours, and multi-market quotes for both the United States, Hong Kong, and China markets. One of the coolest features of Moomoo for new traders is that they have an in-app active community of over 100,000 users who can comment and interact with each other. This allows beginners to learn, casual investors to engage, and active traders to share their investing ideas. Whether you are a new or experienced investor watching this video, Moomoo is a platform that you can grow with over time. They are currently offering 1 or more free stocks to those who open an account and make a deposit, so be sure to use the link in the description below when signing up. Okay, so without further ado, we're actually going to jump into the Moomoo desktop platform. I think a lot of you are going to be using the mobile application, so you're going to be using it probably on your cell phone. But for those of you that want to actually use the desktop application, I will be using that for this demo right now. The reason for that is because it's going to be a little bit easier to see these things as opposed to recording my cell phone screen. And the concept is the same. It's going to be the same exact application, just this one's for the desktop and for monitors. The other one's for your cell phone. So if you look at where my cursor is along the left-hand side of the screen here, we have different tabs, okay? And I'll walk you through each one of these tabs very quickly. So you have account, so this will show you the different accounts that you have. You can see right here where my cursor is, I have about $2,100 sitting in Moomoo right now. It'll show you your profit and loss, your positions, your market value, buying power, all that stuff. So this is considered a margin account, so I can trade more than $2,100. I can actually trade $4,200, but that's outside the scope of this video. So if I go to watch list, you can see here, you can mark different equities or different stocks to be watched and traded. So say, for example, I wanted to keep an eye on Apple or Tesla or Netflix, for example. I can quickly and easily see that within the watch list tab, okay? You can check out your positions. My only position right here is because I got a free stock, which is Sirius. I can click into that, look at the chart right here, so on and so forth. Next is you have markets. This is pretty powerful. So if you look at where my cursor is, you have watch list. So this is just the stocks that I have that I'm watching. But you can also click into broader markets such as the United States, for example. And below that, you have US hotspot. So this will show you some stocks that are actually going up a ton in ROI right now, or in share price. But what you have here is that it tracks market indices, or indexes, if you will. This is the Dow Jones Industrial Average. We talked about that earlier in the video. We have the NASDAQ, which we talked about earlier in the video. We have best performing. Then we have hot stocks, pre-market, after hours, IPOs, which stand for initial public offerings. And then you can actually click into different exchanges. So here we have the Hong Kong exchange. There's China, there's a bunch of different ones. You have options, you have futures. So these are options tradings, options chains, which are outside the scope of this video. You have futures, you have different indices right here all over the world. Forex, which is foreign exchange. So you have currency pairs such as the United States dollar and the Japanese yen, which is outside the scope of this video. You have crypto, Bitcoin, Ethereum, USDT, Tether, all that stuff. So there's so much information in this, and it would take forever to go through this. So I'm just going to show you a couple more different tabs here. We have strategy, so you can actually use quote data to construct a number of short period factors. This is going to create hypothetical situations that you can trade. We have different portfolios, so you can look at different people's portfolios. So these are actually different users within the platform. And you can see, what their total return is. You can see what they're trading over here in the bottom right. So you can get ideas from different users within the community based on their ranking, if you will. So there's daily, monthly, total. There's fans, people that have the most followers. But if you look at monthly, you can see this person right here, their portfolio is up 108%, which is basically doubling their money. And you can see kind of how they got there. So this is pretty interesting. There's data, there's trades, which we'll be talking about. We'll show you how to actually buy and sell a stock. And then you have news, which is very powerful. It's all up to date. And then you have streaming and then paper trading. So if you wanted to trade just with fake money to get started, you click on paper, you choose, what you want, and then you can actually just trade, with fake money or paper money just to see how you would do. So if I go to my watch list, let's use Apple because we've been using Apple this entire time. So there's different things that you can click on. So there's research, there's notes, there's major events, there's options, there's trends, there's all this stuff down here if you want to learn more. But for the sake of this video, I'm just going to show you the demo very quickly on how to buy and sell a stock. So just so you understand what's going on right now, I know it's kind of hard to see, I apologize. But this is Apple's ticker symbol, AAPL. Remember, we have a ticker symbol, and Apple trades on the NASDAQ. That's the exchange that we talked about. So this is the current price per share that's going on right now. So it's trading at $166.31, and this is going to move up and down. So it's going to be hard for me to actually pinpoint an exact price when I'm explaining this to you, but just keep in mind it's trading at roughly $166 per share. So now if I click on trade, this yellow button right here, that's going to open up this trading window right here, okay? This is how you're going to buy or sell this stock. So I know this looks intimidating, but I'm going to walk you through exactly, what to do. So this is the account that I'm using, the U.S. margin account, so you know where your money is coming from, okay? So make sure that, wherever you have your funds, in this case, it's going to be a U.S. margin account. That's where you want to be trading that account with, or that stock with. So we're going to have a type. This one is going to, so we have different types of trades here. So we're going to have limit, market, stop limit, stock market, limit if touched, market if touched, trailing stop limit, trailing stock market price. So this, you're probably like sitting here not understanding anything I'm saying. All you need to understand as a beginner is you need to be trading at limit, okay? So the reason for that is this. So say, for example, we know that Apple right now is trading at $166.35, okay? Actually, I'll pull this back up. It may be easier for you to see this. So we know they're trading at $166 based on the price right here and the price right here. I know this may be kind of hard to see. So if I went to go place a trade, say I wanted to buy a limit order of Apple, that's the ticker symbol we're on, AAPL, and we have the price right here that we can set. So say I'm only going to buy Apple when it reaches $166, okay? That's it. So I put in my price right here, and I put in the quantity, how many shares I want to buy, okay? So say I want to buy one share, it's going to be $166. So you can see here that I can put in one share of Apple, that's what I want to buy. This is actually telling me, I'm able to buy up to 12 based on the money I have in my account. So if I click that 12, it's just going to max out the amount of shares that you can buy. Just for the sake of this example, I'm only going to buy one share of Apple, okay? So now that I've put this in, a limit trade will only be filled when this price gets to 166 or lower. It's going to be filled at 166, okay? So the reason for that is because if I did a market trade right here, that's going to fill at whatever the market price is. So remember, stocks go up and down because of buyers and sellers and what people think the stock is worth, okay? So there's a bid price and an ask price. So the bid price is what people are trying to sell it at. The ask price is what people are trying to buy it at. And right now, you can see the price per share is at $166.38. So if I went to buy this stock right now, it would cost me, I would buy it at market. So that can go up, it can go down. It's most likely going to close somewhere right around this $166.40. You don't want to do that because you're not going into the trade with the entry that you want or that you know you're going to get. It can vary, by a few cents, by a few dollars. It just depends on what the market price is once this closes. Most of the time, it's just going to close on what you see on the screen. So if I traded this right now, I'd most likely end up buying this at $166.40 something, okay? So we're going to stick with a limit trade. So if I stick with the limit trade, you put in your price, you put in your ticker symbol, and say I want to own Apple at $166.00, okay? So I'm going to click here and go to unlock trade. It's then going to ask me for my password, so it knows that this is a legitimate trade. It's just another layer of security, so it knows that it's Marco in this instance buying this stock. So let me put in the password right now. Okay, so I just unlocked that. So now I can buy. So I click buy, and what this is telling me is that it's coming. The money's coming from this account. It's a limit order. I'm buying Apple, AAPL, ticker symbol AAPL, at the price of $166. I'm buying one share for a total value of $166. The time in force is day, okay? So that means that this will only be good for the day, okay? So say trading time closes at 4 p.m. Eastern Standard Time. This trade will be gone after that if it doesn't fill by 4 p.m., okay? So if we go to confirm, we get a little notification. Okay, so now if I click on the trade column or the trade tab over here on the left-hand side of the screen, you can see all of your pending orders right now, okay? So if you see this highlighted tab right here that says orders, so trade status, there's one trade pending, obviously the one that I just put in, which was a limit buy of 1 share of Apple. So right now, it's kind of sitting there pending, and it shows you when you initiated that trade. So in this case, it's April 19th, 1:38 p.m. At the time of this recording. It's a limit order. It's going to be time in force. It's a day trade. And then basically, if this closes, if it goes below 166 or less, this trade will close, and it'll show you your average filled price. So if I was buying multiple shares, these may be filled at like 166, 165.99, 165.98, for example. They may not all fill exactly at 166, but since I'm buying 1 share, this will most likely fill at 166. So this is not really buying the share because I didn't buy it just yet. So what I'm going to do for the sake of this video is I'm going to actually make a market order of Apple, and we're going to go at the current market price. I'm going to buy 1 share, and right now it's sitting at 166.37. So in order to buy a share immediately, I would put in a market order, which I don't recommend new people doing unless you really want to. I'm going to click buy, and it even prompts you and says, you are using a market order. Please note that there's no guarantee on the transaction price of the order. It may be executed at any price, okay? So most likely it's going to be filled at that price, and it is. So you see right here, after you hear the little ding, I now own 1 share of Apple. So I filled this at the market price. I bought Apple right here. The order price was the market price. I ordered 1 share, and 1 share at $166.31.5. That's what it was finished at, or filled at, excuse me. So that took place right here, 3 minutes after our other limit trade, because that still hasn't hit 166 or lower. This trade may never fill. Say Apple never goes below 166 again. This may just sit out there until it's canceled, or it sits out there forever, depending on how I want to set it up. So I now own 1 share of Apple. So if you look at my positions up here, you can now see that I own 1 share of Siri, 1 share at 636. Okay, I have 1 available share of Siri to sell if I wanted to. I have 1 share of Apple to sell if I wanted to. You can see the percent change since I've actually inherited Siri from getting a bonus on Moomoo. It's actually down 7.29%. And then you can see how much of your positions it is, et cetera, et cetera. So that's all you need to know if you want to buy a stock. Now, how do we sell a stock? So you would go to the stocks that you own. You can actually sell stocks that you don't own, but that's definitely outside the scope of this video for beginners. So say I wanted to sell this share of Apple that I just bought. So you can do a couple different things. Again, you can do a market order. So say, for example, this was 2 weeks later, and Apple is sitting at $170, okay? So I can do a market type or a market sell, if you will, and whatever Apple is trading at that is what it's going to sell at. So if it's 170 and I want to sell my 1 share of Apple at 170, that's most likely what it's going to fill at, okay? Now, if you're smart, you want to do a limit order, okay? And the reason for this is because you know exactly how much money you're going to be getting for your sale, okay? So, for example, Apple right now is trading at $166.27, $166.27. Obviously, that's fluctuating as I speak. But if I wanted to set up a limit sell, I can put in my price right here, limit price, market price, whatever I wanted to do. Let's just say I wanted to sell this at $167 a share. So you can see here exactly how much you'd be getting. You'd be getting $167, okay? So now if I want to sell it, I can set this up, and now I have a pending sale, okay? So remember, I have a pending buy that still didn't execute because it didn't go down to 166. Now I have a pending sale that didn't execute because the stock price is not 167. It's still sitting at 166.29. So this is going to fill whenever it reaches $167, okay? Makes sense. So now, say for example, I need money right now. Say, God forbid, something happened and I need to sell these stocks right now, right this second. So I'm going to go to number 2. I'm going to do a market order, and I can sell it at this right here. So if I click sell, I'm going to be able to sell my 1 share of Apple at 166.26. So if I click that, it's going to tell me you still have a pending order of this stock in the opposite direction. So I have to cancel the opposite direction order and try again. So what I'm going to do is I'm going to cancel this right now. So I have the buy order right here. I'm going to click cancel. Don't remind me again. Got it. Boom. So now this order that we had at 166 is now canceled. Okay, so this is most likely not going to go through because remember, I have a pending sell order at 167. So I can't sell 2 shares of Apple that when I only own 1. So I'm going to have to cancel this order as well. So I canceled that limit order or limit sale, excuse me. And I'm going to go here, market, and sell this. And then boom, this was filled. Okay, so you can see that this filled right now. I sold this at market price, 1 share at 166.245 cents. Okay, so remember, if I go down here, you can actually see, your trades for the day or the histories, if you will. You can see that I bought 1 share of Apple at 166.315, and I sold it, just for the sake of this video, as a quick example, at 166.245. And you can see here that today's profit and loss is -7 cents. Okay, that's the difference between these two numbers. So there's a lot more to unlock within Moomoo. But this was just a very simple way of showing you how to buy and sell stocks on it. I know this looks intimidating. I know it looks crazy if you haven't been doing this for a long time. I've been investing for 16 years, so I understand what this lingo means. But if you want to take a tutorial or look at other tutorials, there's definitely tutorials out there as to what types of orders and things these are. If you're not comfortable with Moomoo, there's definitely other brokerages out there. But I decided to use this as the broker in this example just because it has a ton of features that you can really grow with. Okay, so let's talk about taxes and fees now that we've actually bought and sold our first stock. So a lot of this is pretty simple. Depending on what types of shares you own, sometimes you can have like REITs that are taxed differently. Sometimes you have dividend stocks that are taxed differently. Sometimes you have covered call ETFs that are taxed differently. If you remember when we talked about ETFs and index funds earlier in this video. But for the most part, this is what you need to understand as a beginner, okay? So to incur a capital gain, this is basically selling a stock for more than what you bought it for, okay? So you made a gain. So say you bought for $100 and you sold it for $110. This would be a capital gain of what? Obviously $10. You made $10. A capital loss works the same way. This is you sold it for less than what you bought it for. So if you bought a stock for $110 a share and you sold it for $100 a share, you have a capital loss overall of $10, assuming you just have 1 share. So what you guys need to know is the durations. So a short-term capital gain or loss is less than a 1-year holding period. This is considered a regular taxable income. So say, for example, you bought a stock on April 1st, 2022, and you sold it on May 1st, 2022. This would be a short-term capital gain or capital loss because you held on to this security for less than 1 year. This is taxed at your regular taxable income level. So whatever that percentage may be, that's what you're going to get taxed at. Now, the IRS, they want to incentivize it that you want to hold these stocks or equities longer, okay? So they incentivize it by taxing you somewhat less on this. So you're going to have a long-term capital gain or loss. This is when you've held an equity or held an equity longer than 1 year. So say, for example, you bought that same stock on April 1st, 2022, and you sold it May 1st, 2023. This is obviously 13 months later. This is longer than a 1-year hold. So depending on your filing status and income, you're either going to be taxed at 0, 15, or 25%. This is much lower, and this is why the government wants you to incentivize you to hold these stocks longer than shorter. And they also punish day traders with this as well, but that's beyond the scope of this video. So again, I just wanted to cover the free gifts and added value of this video. Please download this presentation. There's a link in the video description below. It's absolutely free. We're offering free stocks if you use the link below to Moomoo. This is the platform that we just used in this video. You can click on either of those links and you'll get a free stock from Moomoo by signing up and also by depositing some money. So again, check the description below for that. And then, as always, be on the lookout for Whiteboard Finance University. Join the waiting list with that link. Again, we're going to have courses. classes, live Q&A with me, most likely once a week in a live stream, and then we're also going to have the community Discord. So with all that being said, this video was a mouthful. I know some parts were boring, some parts were exciting, but again, I'm offering this to you because it's generational wealth. You have the opportunity to build generational wealth, and stocks are more intimidating than they seem. I hope this video simplified it for you. As always, I have your best intentions in hand. Again, do due diligence, trust the process, use the things that we learned in this video. Don't just blindly click on buttons and buy stocks just because someone said it was a hot stock tip. You need to understand what you're doing when you buy it and why you're buying when you buy it, okay? So have great trading. As always, thank you so much for watching the video, and have a prosperous day.